David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm. It's now time for User-Friendly Finance with Dave Weaver from SWC Wealth Management on News Radio, WHP 580. If you have a question for Dave, call 540-0580. Now with today's show, here's Dave Weaver.
Hi, good morning. This is Dave Weaver with SWC Wealth Management, bringing another edition of User-Friendly Finance today as we talk about, today we're going to have another tax show. It's just me today, not Megan or Tom, just me. And we're going to talk about the changes for the 17 taxes that you may or may not be starting to file right now, even as we speak. We're going to cover things that change from last year's tax law to this year's tax law, just applicable to 17. And if you have any questions as you're starting to put together your own tax returns, feel free to give us a call, and we'll try to entertain those. The contact information for SWC Wealth Management, just in case you want to get in touch with us during the week, we have two office locations. We're in Palmyra and in Carlisle. In Palmyra, we're at 103 West Main Street, and in Carlisle, we're at 35 East High. Both of them are about a block off the square. You can reach both offices at the primary number, which is 717-706-0700, or you can reach us via the web at swcwealth.com. We're in the process of trying to make some changes to our phone service, also updating our website. Both of those are pending. Hopefully the phone will be all fixed up and working this week, and then the website hopefully in a couple weeks. That takes a lot longer in our business than it does in others because we have to run everything that we change through our compliance department, and it just is a lengthy process depending on what you're saying and how you say it, and all the words have to be very specific. One thing you know that we're definitely not allowed to say is guaranteed. The word guaranteed can't be anywhere, so there's no guaranteed returns spotted anywhere on our website. And there are a bunch of other things. Pretty much every word has to be analyzed and scrutinized to make sure that we're not making any promises that we can't keep or saying anything that we shouldn't be saying. Any broker-dealer has to go through this, or any financial advisor has to go through this when they have a website, or even if they're doing a show like this, we have to, from our broker-dealer, we have to submit a script and go through some additional scrutiny before we're even allowed to talk about some things on the air. So that we're not committing things that we can't commit to, or making promises we can't keep, or saying things that factually aren't accurate. So anyway, with that, the subject today is going to be talking about the taxes for 2017, which you are going to be starting to file and put together. If you haven't already started, will be soon. Information is going to start trickling out to prepare those taxes very shortly. The W-2s have to be mailed by the 31st. 1099s are supposed to be out by February 15th. And you should start, if you don't already have your information, stuff should be starting to trickle in soon. Some people are anxious to file the first day to file this year. The first day the IRS is accepting returns is coming up this week on the 29th. If you have certain credits, such as the earned income tax credit or additional child tax credit, those things will have a 21-day hold before they can process the refund. So, and that's true from whatever day you file. It's not just if you file early. If you file late, they have that same hold period for those specific credits, regardless of when you file. Because of the amount of fraud, those are the most fraudulent areas the IRS feels in the tax return. So Congress gave them additional time to process a refund so they could do some additional checking, ask some additional certification questions before they actually process those refunds. If you have questions as you're going through today, if you have questions on your own return or questions about anything that we're talking about, feel free to call. We have the $10 Panera gift cards, and I guess we'll have to come up with something different at some point here. But right for now, we still have the $10 Panera gift cards if you call in and get on the air. Call number here is 717-540-0580 or 800-724-5801, or it'll get your information and get you on the air. So I wanted to start by One of the most common questions we get, which is one you wouldn't think would happen a lot, but we get a fair amount, is do I even need to file a return? And I'll just tell you from my own perspective, I like filing a return whenever I think somebody will get something that could be questioned as to why you didn't file it. But for the most part, the majority of people who have any kind of income have to file. That's probably the simplest part of it all. But self-employer taxpayers, as a result, a lot of people think if you're not making much money, you don't have to file. But if you have at least $400 of net earnings of self-employment tax, you still have to file a tax return. And non-employee income, that includes income you may receive on a 1099 miscellaneous, which is if you're a contractor for somebody delivering papers, some of those various types of activities that are considered self-employed. If you have at least $400 of net income, you have to file a return. But other things that people aren't sure about, if you have some other reason to file that you may not think you would have to file, or if you have a recapture tax, which I don't know if you remember years ago, we had a home buyer's credit that if you sold your house within a certain amount of time, you actually had to pay the credit back because you got a credit to buy it. And if you sold it within a certain period of time, you had to give it back. That's still coming into play for some people. Alt-min tax, if you have something that applies to that. If you have uncollected Social Security, which you had not received in the past but received this year for prior years, that's claimable. And household employment taxes have to be filed regardless of whether you have other income. If you paid somebody to work in your home, taxes on tips that you may not have reported to your employer are theoretically filed. A lot of people don't file those tips that they may have received. A lot of waitresses and waiters get money that their employee may not report. Theoretically, you're supposed to file those because your employer has not withheld taxes. If you haven't reported them, the IRS doesn't get a record of them and don't know that there's tax owed on it. But in theory, you're supposed to file that. You also need to file a tax return if you have wages of $100. I don't know how they came up with this number of $108.28 or more from a church or qualified controlled organization that's exempt from payroll taxes. So, I don't know how they come up with some of these rules, but if you're working for a church made more than $108.28, that's pretty specific. You have to file a return. If you make advance payments and got the premium tax credit, and those payments were made for you on your behalf, if you enrolled in coverage through the health marketplace, you need to do that to reconcile that amount. And don't forget some of the tax favored accounts. You may need to file a return if you received an HSA, an Archer MSA, a Medicare Advantage MSA, a distribution anytime during the year. If you took an early distribution from a qualified plan, such as an IRA or 401k, more than one appropriate amount from the retirement plan, like an IRA, you may also need to file a return. And if you didn't take your required minimum distribution, and you are supposed to, you'll need to file a return just because of that. Now, a lot of people wonder about the required minimum distribution. That happens when you turn 70 and a half. The penalty for that is 50% of the amount that you didn't take that you were supposed to take. So you want to make sure that you take that. But that may be the only record that the IRS has of that. I've never understood the timing for this. I guess we better cover that after the break. But we'll talk briefly about the RMDs and why you need to report that. And we'll be back again. This is Dave Weaver with User Friendly Finance, talking about some of the things that are going to impact your 2017 return, which you should be filing right now. Call in number 717-540-0580 or 800-724-5801. We'll be right back after the break. Again, this is a dry subject for a wet day as we talk about the tax changes that are coming into effect for this year. There's a bunch of little things, and nothing really big, because we have a lot of big changes coming in 2018 with the Trump tax cuts, or whatever the official name is at this point in time. It's still getting called various things in various places, but we're talking about just the 17 taxes because you'll be getting ready to file those here in the coming weeks if you haven't already started. And we were talking about some of the things that are, some reasons you might not have to file. And there are other things that will pretty much force you to file. And here's what you know about some of the effects that are having to do with health care specifically. If you're not required to file a tax return in 18, you're considered exempt from the shared responsibility payment, and you do not need to file a tax return to claim the coverage exemption. So that's a benefit for people that are under the health care but ordinarily would not have to file a return, some of the reasons we covered in the first part of the show. If you're required to file a tax return in 18 and did not have minimum health insurance coverage for all of 17, you also need to file a Form 8965, which is a healthcare exemption form. So that would be one reason to file a return, just so you can file that form along with it. And you have to file a return to be able to cover the advance payments you received in 17. If you received advance payments in 17 and fail to claim the premium tax credit on a federal return, this could bar you from receiving additional advance payments in the future. So that's to say that if you receive credits and want to continue to receive those credits, you have to file a federal tax return to get it. So yeah, you want to make sure you file in that circumstance. The new tax law repeals a mandate, the healthcare mandate, but not until the 2019 tax year. So for now, that mandate, remains on the books. And one thing to remember, all the things that we're talking about apply to the federal tax law and federal tax returns. In Pennsylvania, as an example, there's no personal exemption for individuals, which means that you're taxed on the first dollar that comes in, and it's possible you might have to file a state or local return even if you don't have to file a federal return. I think Pennsylvania, the threshold is around, I can't remember the exact number, $37 or $39. Whatever it is, it takes you to owing $1 of tax. You're technically required to file a return. So you have some things that don't count on the Pennsylvania state return, such as your Social Security pensions and things like that. But as soon as you reach $1 of taxable, enough income to create $1's worth of tax, you're technically supposed to file a return. And while we're sort of on the subject of filing or not filing, I like to file something whenever anybody gets something the government gets a copy of, because you don't want a letter down the road. People get nervous when they get a letter from the IRS, and if you get a pension, for example, or have an investment account that might have a capital gain or loss, and you get a letter down the road that comes back and says, why didn't you report that, even though you technically wouldn't have had to file? It's easy enough to say I didn't need to file, but people just get nervous when they get those letters. So I usually file something if people get something that could be questioned by the IRS, not so much Social Security, but investment or dividend income or pensions. I'll typically file just because I don't want a letter down the road. And a lot of times, even for seniors, they may not even have state income tax, which I don't file, but they may have income that qualifies for the home or property tax rebate or property tax and rent rebate. So we'll file. You have to in our software anyway, you have to enter that information to have it follow through to that form. So I usually just file anyway. The local, the first year you don't have to file, which is the year that you don't have enough income to have a local income tax return. I usually file something that says you don't no longer qualify for tax and that you've retired, and that should stop you from getting the notices in the future. So I guess enough about the things and reasons that you may not have to file. Let's get into some of the things that are a little bit different for the 2017 tax year. Again, if you have any questions, feel free to give us a call or call our office at 717-706-0700. The IRS does have new 2017 tax tables. Probably the easiest way to find those is to just Google them. The rates are there if you want to find out what they are. And the number you look up is the actual taxable income, which is after your itemized deductions or standard deduction and your personal exemptions, which go away for 18 but are still in place for 2017. The new withholding tables for 2018 are supposed to be ready any time now from the IRS, I think sometime in February. While these taken at 18, they don't affect your 2017 tax return until, they won't come into effect till the January 1st of 2018. All those new tax rates and new tiering of the income come into place for 18, but you have the old tax information for 17 still. Again, the rates change from 16 to 17, so it won't be exactly the same as 16, but the form itself will look pretty much the same. The front of the 1040 looks a little bit different this year. There's a place at the top, or I'm sorry, on line 34 that if you look closely, it says reserved for future use. That looks exciting. Well, exciting to a tax guy, not really exciting to the average person. But it's really not. The IRS had anticipated that the now expired tuition and fees deduction could be reinstated as part of a last-minute retroactive extended legislation. That didn't happen. So the tuition and fees deduction remains expired, meaning that there's no tuition and fees deduction available for 17. And rather than redesign the form again for this one change, the IRS just left it in place with a placeholder. Tuition and fees deduction came into place if your income was too high to qualify for the regular education credits. That also had a phase-out number, but that deduction went away. Standard deduction and personal exemption, you hear they're going away for 2018, but they're still on your 2017 return. The only difference is that they're adjusted for inflation and just up a little bit higher than they were last year. So if you compare one return to the other, they should look pretty similar in terms of the standard and itemized deduction, how that works, and also the personal exemption, which is about a little over $4,000 a person. There's one significant change that comes into play on Schedule A, which is if you're itemizing, that's where you take care of the things like your medical expense, real estate taxes, mortgage interest, miscellaneous deductions. All those come into place on Schedule A. They have to exceed the standard deduction, which is in the neighborhood of $6,000 for single people, $12,000 for married for 2017. But the one big change on Schedule A for this year is that the 7.5% floor for medical expenses is back in place for 2 years beginning on January 1st of 17. It's called a floor because you can only deduct medical expenses over that percentage of your adjusted gross income. So let's say your adjusted gross income is $40,000 and your medical expenses are $5,000. If you itemize, you can claim $5,000 in expenses less the floor, which at 7.5% of $40,000 would be $3,000. You'd have a $2,000 deduction. That's effective retroactive beginning to the beginning of last year, so you'll see that change on your 2017 tax return. That medical deduction is confusing as heck. A lot of people think, boy, I had a lot of medical, I'll be able to claim it this year, but it still has to be, before you can claim the first dollar, it has to be 7.5% of your adjusted gross. The reason that's kind of a big deal, or why it's a change from prior years, is they're still messing around with this deduction for some reason. They made it had always been 7%, then they raised it to 7.5%, then they raised it to 10% if you were under 65, then they made everybody 10%. Now they're dropping everybody back to 7.5%, and in 2 years it's going back to 10%. So why, I don't know. Again, the mystery of the IRS and how the federal government works to figure out the tax law is still a question. There are still limits on itemized deductions. So if your income is above a certain level, phase-outs start to apply. Those levels are pretty high, so most people, if they deduct, can deduct whatever is eligible on the Schedule A. But if your adjusted gross income is more than $261,500 for a single taxpayer, or $313,800 for married taxpayers, you will start to have a phase-out of your itemized deductions. That said, don't confuse the overall limits on itemized deduction with the caps and other limitations that apply to individual itemized deductions. As an example of that, charitable deductions are limited to 50% of your AGI. That's going to also change in 2018 to be 80% of your AGI. But you're being encouraged in the new law to keep making charitable contributions, but they raise that standard deduction so high that people may not have enough charitable deductions to qualify. The average person may not. So that's the world of itemized deductions and what's changing from 17 to 16. There There are no significant changes for Schedule C, E, or F. C is if you're a sole proprietor business. E is typically rental real estate, and F is a farm return. There are some changes that will impact those areas for 2018, but for 2017, things are staying pretty much the same. You still have to report whether or not you have health coverage in the 2017 tax return. The repeal of the mandate takes effect in 2019 and will affect your tax return until you file in the year 2020. So for 2017, you're still required to demonstrate that you have health coverage. If you don't have health coverage, you have to claim a waiver or exemption or be subject to a penalty. So in the past years, if you failed to tick that box, the IRS would still accept and process your return. That's no longer the case. For the 2017 tax year, the penalty, which is payable in 2018, is equivalent to 2.5% of your adjusted gross income, or up to a maximum of $695 per adult or $347.50 per child. I'm sorry, up to a maximum of $2,085, whichever's higher. So 2.5% of your adjusted gross or a maximum of $2,085. So with that, we'll take a break. Boy, this is exciting. The tax guys are the only ones that really get into this, but if you're filing your own return, trying to use TurboTax, just a way to try to help you as you're scrolling through and trying to plug your stuff into the software. This is Dave Weaver with User Friendly Finance. We'll be back right after the break, continuing our changes for the 2017 tax year. Hi, this is Dave Weaver again with User Friendly Finance from SWC Wealth Management. Just wanted to make another plug again. If you have any questions during the week, give us a call at area code 717-706-0700. You can also reach us via the web at swcwealth.com. We try to get to every call or respond to everybody within at least 24 hours, hopefully sooner if we can get to it. This time of the year, it gets a little harder to do as we get a little more bogged down on the tax side. One thing just on the subject of taxes, other than our subject today, which is changes to the 2017 tax return compared to your 2016. If you have investments, don't feel like your financial or your tax preparer is fully understanding how to prepare your return, and you want us to take a look at your taxes, we'd be glad to do that. You can reach us at 717-706-0700. We also work with people to make sure that they get the best tax advantage from their investments. So if you have investments and don't feel like you're fully taking advantage of all the tax opportunities that are out there, give us a call, and we'll be glad to try to help. The subject today is the things that are different from 2017 to 2016 on your tax returns, and some of the things we've covered so far, whether or not you have to file. Some of the things that are a little bit different. Next, we're going to be talking just a little bit about your W-2. Your W-2 actually looks a little bit different. There's a new verification code in Box 9. Some formers had that last year. It was the first year they put it in there. The verification code, last year there were about 2 million that were showing up on the W-2s. This year there are 50 million W-2s still have have that code in them. Not all W-2s will have them, but they're starting to use it as a way to help prevent fraud. If you e-file your return and your W-2s have a verification in Box 9, you do your own return, include it when prompted by your tax software. You don't need to enter the verification code if you file your return on paper, but you do if you're filing electronically with software. There's another security measure intended to combat identity fraud. The IRS has upgraded its identity verification process for certain tools that are available on irs.gov, including e-services and your online tax account. I did that myself just to see what it was like. It takes a little bit of time, maybe 10, 15 minutes. It's not a hugely problematic thing, but again, it's a way for the IRS to try to combat fraud, and you'll you also be able to use that site as a way to check on the status of your return. If you're wanting to do that, you log into irs.gov with your user ID and password, and it'll take you to a process, and you'll be able to check on the status of your refund. Refunds this year, like I mentioned before, the IRS is required by law now to hold refunds that are tied to the earned income tax credit and additional child tax credit. Those are not allowed to be processed before February 15th. The rule which bars the IRS from issuing those refunds before mid-February applies to the entire refund, even the portion that's not associated with the earned income tax credit or the additional child tax credit. There may be additional delays when you factor in weekends and the President's Day holiday. The IRS expects that the earliest earned income tax credit and additional child tax credit related refunds to be unavailable in taxpayer bank accounts or debit cards starting on February 27th of 18, which is, for the early filers, that's a long way away. A lot of people with those credits are some of the first people that file. So don't be surprised if it takes a little longer than you thought and they hold up the entire refund, not just the portion that has to do with, not just the part that has to do with those credits. And in general, they say you should wait. Assume it's going to take 21 days to process your refund. It may be quicker than that, but not necessarily. Wouldn't expect it to be quicker than that. And that's probably a good worst-case scenario to keep in the back of your mind. The some other things that we want to talk about that are changing. The healthcare coverage we already talked a little bit about, but there are limits for tax-deferred medical savings accounts for the self-employed, where the maximum deductible expense amounts changed. For self-coverage, the amount was $4,500, and the deductible limit on a family plan is now $6,750, and the minimal deductible family amount will be $4,500. Those all increased by $50, and the limit on out-of-pocket medical expenses under family coverage is now $8,250, which increased by $100. One of the we talked before about a benefit for a lot of people that are getting the medical expense threshold dropped to 7.5%, which was 10%. That was not a benefit to the people that were over 65 because they were already paying 7.5%. But for everybody else, that'll be a drop. And thanks to relatively low inflation, the 2017 tax bracket changes are minimal. You'll see big changes with 2018, but adjustments range from a $50 income increase for single filers in the lowest bracket to a $33,550 increase to reach the 39.6% bracket. Filing is ahead of household. Standard deductions raise $50 for single filers or $100 for married couples filing jointly, and the full 2017 tax brackets for use in 2018 filing. The best way to find those is to go and just look them up. Probably, just Google 2017 income tax brackets. It's a little late to make some changes. You can contribute to an IRA up until right up until the deadline, which is April 17th this year. But you can file right up to the deadline with an IRA, and that will reduce the amount of tax you have if you're trying to keep yourself out of the next tax bracket. Sometimes contributing to an IRA at the last minute can do that. If you're self-employed, you also can contribute up to the due date of the return plus extension. So you actually have to October to file, to make contributions to a SEP, to set up the SEP and file it. If that's something that you owed and are trying to keep yourself, or you're trying to keep yourself out of the next highest tax bracket, either a SEP or simple contribution is one way to do that. It's one of the few things we can do after the first of the year that will allow you to make a change to your adjusted gross income. Some other 2017 adjustments for the phase-out for traditional and Roth IRAs were both raised by $1,000 in 2017 for single taxpayers and $2,000 for married filing jointly couples. Exemption amounts for the alt-min tax raised to $54,300 for individual filers and $84,500 for married couples filing jointly, and the maximum earned income tax credit is now $6,318 for taxpayers filing jointly. So those are some of the things that changed for the tax year. We'll go back again. If you have any questions, feel free to give us a call if you're trying to prepare your own personal return. Other than that, we'll take a break. We'll be back in just a few minutes. Seconds. Hi, this is Dave Weber again with User Friendly Finance, brought to you by SWC Wealth Management. I'm here by myself today, Megan and Tom. I think one of them will be back next week, and we're going to start talking about the 8 wealth management issues that we use as a way to talk through our clients through the financial planning process. And we'll start with an overview, I think, and then go through the various 8 wealth management issues to help you get a better idea of how you want to start planning your financial future if you haven't already started to do so. If you want to contact us during the week, the number is 717-706-0700, or you can reach us via the web at swcwealth.com. If you have any questions on your own personal tax return or any of the things that we've covered so far, give us a call at 717-540-0580 or 800-724-5801. I was going to finish up the show by talking about some of the tax breaks that expired in 2016, so will no longer be available in 2017 unless by some last-minute miracle they go back and retrieve them and make them retroactive to the 1st of 17. The first is the alternate motor vehicle tax credit. I don't know anybody who bought one, but if you bought a new fuel cell car, an SUV, you could claim that on your 2016 federal tax credit based on the make and model of your vehicle. You had to buy the vehicle, not lease it. That goes away. There was a credit linked to the purchase of new e-bikes. I remember a couple of people called and asked about that, driven by electric motors with batteries that could be plugged in and recharged through an external source of electricity. That's going away. We didn't have any questions about it this year, so maybe that's the reason. I'm not even sure. I'm not even sure I've seen one of those. You ever seen one of those, Art? No. Oh boy. There was up until 2016 a mortgage debt forgiveness deduction. This is a credit where if you haven't taken it, maybe it's worth going back to amend. It's totally up to you. But forgiven or canceled debt is usually taxable. But in response to the mortgage crisis of the late 2000s, Congress had passed legislation that let financially troubled homeowners have a tax break on forgiven or reduced mortgage debt that would ordinarily have been taxed. And there was up to $2 million of such debt on a principal residence, or up to $2 million of such debt on a principal residence could be excluded from taxation thanks to that tax break. I don't think a lot of people were aware of it, but it was available. That's going away with the mortgage crisis in the rearview mirror. That's been allowed to disappear. So that went away. But if you did have it, if you had debt canceled because your financial situation filed through the federal government to get it, you can actually not claim that income. If you did, but by accident, you can go back and refile or amend those returns. We already talked about the medical expense deduction. We also talked briefly about the tuition and fees deduction, but this was, like we had said before, this was an above-the-line tax deduction. It showed up on the first page of your 1040. That could be taken even when a taxpayer didn't itemize, and it could be as large as $4,000, and you could use it to claim for any qualifying tuition and fees that you paid for yourself, your spouse, or a dependent. Even if those expenses were paid for with a student loan, the deductions could still be claimed. This deduction, which was subject to phase-outs at higher income levels, could be claimed instead of the American Opportunity or Lifetime Learning Credit, which were actually higher credits, but had lower phase-outs for income qualifications. Some other interesting developments: the 50% bonus depreciation ends this year if you're a business owner. They'll see a gradual phase-out for immediate expensing of assets that they acquire. In 2017, you can still take the 50% bonus depreciation deduction, but the ceiling on that lowers to 40% in 18 and 30% in 19. As it stands now, this is scheduled to disappear in 2020, and whether it's extended past that date, its oncoming phase-out could significantly impact your taxable income and cash flow of businesses. Of course, a company can still elect to use the Section 179 for new and used equipment, which has a $500,000 yearly limit. I think that's potentially going to change as well. The IRS is going to wait till February 15th to process any refunds that are due to taxpayers claiming the Earned Income Tax Credit or Additional Child Tax Credit. We talked before the fact that you shouldn't expect that before the end of February. Taxpayers with lower incomes may be eligible to claim that earned income tax credit. Don't be afraid to claim it if you're owed it. And the child tax credit, when the standard tax credit surpasses your federal tax liability, you can claim the refundable additional child tax credit, which can be as large as $1,000. Claiming either of those credits, it looks like, you won't receive your refund until the very end of February at this point in time, and expect 21 days from the day you file. The taxpayers without health coverage may or may not have to pay an individual penalty in 2017. In an executive order signed on January 20th, President Trump called for departments of the federal government to waive, grant exemptions from, or delay the implementations of provisions of the Affordable Care Act, placing penalties for individuals or businesses. This is wisely interpreted. It was wisely interpreted as a directive to jettison that penalty. When 2017 began, the individual household income or $695, whichever was higher. If the Trump administration follows through on its intention to replace the Affordable Care Act, which it's trying to do still, I guess, we're still in the middle of trying to figure out what to do with all that. The health mandate is vanishing this year. Another change from year to year, if you use the mileage rates for business expense, for personal business expense, for business, medical, or charitable purposes, the rates for those have changed slightly. You could deduct 54 cents a mile for business miles, 19 cents for moving miles and miles driven for medical purposes, and 14 cents a mile when driving for a qualified charity. That the rate this year has dropped like half a cent. Went from 54 to 53.5 cents for business miles, 19 to 17 for moving and medical, and 14 cents for charity miles. So a lot of people think that charity miles are the same as the business miles, and it's not, and the moving miles are also not the same. So people think they are, and they're just definitely not. 2017 is probably going to mark the last year of the suspension of the 2.3% excise tax on medical devices. Medical device manufacturers may not have to worry about this tax coming back. It may disappear altogether in 2018. As lawmakers in both the House and Senate introduced bills to repeal it. The tax was first waived in 2016. Some taxpayers who haven't filed a 1040 recently may need new individual taxpayer ID numbers. Usually you use your Social Security number as your ITIN or individual tax identity number. Some U.S. residents don't have Social Security numbers yet still file taxes, and they're issued ITINs, which are Social Security numbers. When the 2015, this is all very complicated. When the 2015 Protecting Americans from Tax Hikes Act became law, it established the ITIN will expire for those taxpayers if they go 3 years without filing a federal return or being listed as a dependent on another individual's federal tax return. So if your ITIN hasn't been used on a 1040 from at least once in 14, 15, or 16, you'll have to get a new one for 17 to file your tax return this year. Taxpayers in this category who were issued an ITIN prior to 13 will be asked to renew that ITIN sometime during 2017 through 20. I don't know if anybody's got that situation. I just talked to somebody the other day who refuses to give his Social Security number for anything. So they would have an ITIN, which doesn't have the same correlation to all your other records. So that's a quick view of all the things that have changed for this year. Again, some of the most common questions we get are, do I need to file? We tried to cover that early on. The next one that we're getting a lot is, how am I going to be impacted by the new tax laws, which doesn't affect your 2017 filing, but think about that as you put together the information for your 2017 return, and when you get it back, look at that return, get a summary, find a summary of the tax law changes, and see how it impacts you. The quick way to try to figure that out is to add up the lines on your tax return for 17 when you get that completed. Look at the lines for your deduction, whether it's a standard deduction or itemized deduction. Add that number to the number that you have for your personal exemptions, which are as 4,040 or so times the number of people you have. Add those two numbers together. If it's below $24,000, which is the new standard deduction, that means in that case you've probably taken a little bit of a hit. Or I'm sorry, if it's below, you get a little bit of a benefit. If it's above, you may take a little bit of a hit. But then you have to take your taxable income times 2% or so, 2 or 3%, depending on your tax bracket. Figure out where you are in the new tax bracket. It's a little complicated. A lot of the tax software hasn't been updated yet to reflect the new tax law. So if it has a tax planning capability, it may not be working yet. So be patient. I would say by June or so, take a look at your tax situation, contact your tax preparer or look at your own taxes, figure out if you're withholding the correct amount so you don't get a surprise in this time next year. So that's, I guess, most of what we wanted to try to cover for the 2017 tax year. I know for myself, this always starts to be a busy time. People expect to get stuff sooner than they actually do. Go through what you got last year. Make sure that you're getting, maybe even make a checklist. A lot of tax preparers have organizers, but write down all the things you got last year and check off at getting them again this year. W-2s, 1099s, from interest or savings, from a brokerage account or investment account. All those things come into play as you're putting together this year's tax return. Good luck with your 2017 tax filing season. If you have any questions, give us a call at 717-706-0700 or reach us via the web at swcwealth.com. This is Dave Weaver with SWC Wealth Management and User Friendly Finance.
David Weaver, Megan Wall, and Tom Pop. Securities offered through HD Vest Investment Services, member SIPC. Advisory services offered through HD Vest Advisory Services, 6333 North State Highway 161, 4th floor, Irving, Texas, 75038, 972-870-6000. SWC Wealth Management is not a registered broker-dealer or independent investment advisory firm.